From Deloitte Tax, welcome to the Tax News and Views podcast. In this series, we talk to specialists from Deloitte about the latest business issues and developments. I'm Carrie Falkenhayn, your host for Tax News and Views. And today we are recording a special tax policy edition to discuss a new tax plan, which was just unveiled by Ways and Means Chairman Jason Smith. Joining me are my frequent guests on tax policy topics, John Traub and Anna Taylor from Deloitte's Tax Policy Group. Happy New Year, you two. Welcome to the podcast.
Hi, Carrie.
Happy New Year. Thank you, Anna. So Congress just returned from its 2023 holiday recess, and we already have a tax package to talk about. Anna, maybe start us off with what do we know about it?
Sure. It largely follows the contours of what we've been looking at for some time now, with a few wrinkles. It includes the retroactive fix for the three pieces of TCJA that needed to be fixed. That's Section 174 R&D amortization, Section 163J, and bonus depreciation. It also includes a key priority for congressional Democrats, which was an expansion of the child tax credit. And specifically, it is going to allow the refundable portion of the credit to be calculated on a per-child basis and gradually increases the limit for refundability as well. It's going to also index the maximum credit for inflation going forward as well. So that was a big priority for Democrats in this negotiation. It also has a modification to the low-income housing tax credit to increase state allocations of the credit and to reduce the tax-exempt bond financing requirement. And lastly, the last big piece would be a modification to the existing employee retention tax credit, which has been in place since the pandemic. And that provision would accelerate the deadline for filing claims for the credit to the end of this month, January 31st of this month. It would also impose new reporting requirements and restrictions on promoters of the credit, and it would extend the statute of limitations by 1 year for COVID-related ERTC claims. So that's, really a summary of the highlights of the package as we've seen so far today.
All right. So, Anna, you mentioned wrinkles. John, do you want to talk about what some of those are?
Yeah, there's sort of 5 things I would mention, 3 of which are taxpayer friendly, and then 2 of them are definitely taxpayer unfriendly. So on the friendly side, as Anna mentioned, it does have the low-income housing tax credit change. It has a small disaster tax package to help victims of wildfires in the East Palestine train derailment in Ohio. That'll be welcome news for some of the members of Congress whose constituents are still recovering from disasters. It also has language that's been worked out for some time between Finance and Ways and Means to address double taxation of companies doing business with Taiwan. It looks and sounds a lot like a tax treaty, but because of our One China policy, we can't do tax treaties with Taiwan. So this is sort of a legislative workaround that provides a prevention of double taxation for companies doing business in Taiwan. But then the 2 unfriendly things for taxpayers. One is, while it does retroactively fix the 174 R&D rules for domestic R&D, it does not do the same for foreign R&D. Under current law, domestic R&D is amortized over 5 years, foreign R&D amortized over 15 years. The proposal changes the 5-year rule for domestic R&D and makes it retroactive back to January of 2022. But it does not change the fact that foreign R&D would still need to be amortized over 15 years. And then, as Anna mentioned, there's a suite of changes to the employee retention tax credit. A number of businesses are still claiming that credit. Members of Congress, at least some, have been concerned about growing reports of fraud in that area, and so have been looking for a way to sort of stem what they see has been an improperly opened spigot in federal funds. But for taxpayers who are hoping to claim the credit, that will be definitely an unwelcome change.
And are these changes to the employee retention tax credit all designed to use this as a pay-for this bill?
Well, 2 comments here, Carrie. One is we have not yet seen a score from the Joint Tax Committee, but we expect it will show that the net effect of change in the employee retention tax credit with the other changes is to have 0 impact on the deficit. Now, some people will say, aha, We are paying for the bill by clawing back ERTC. But I think when you listen to what Jason Smith, the Ways and Means Chairman, says, he will say it very differently. He will say, we are replacing bad policy with good policy. And this is a really important distinction. Historically, Republicans have never paid for extending tax policy. They've always said we shouldn't have to raise taxes on some group over here to pay for a tax increase, to prevent a tax increase on this group over there. And so that's been Republican orthodoxy for a long, long time. Yet we know there's a group of Republicans in power now who are much more fiscally focused than their predecessors. And so to alleviate their concerns, the package is basically paid for. But Jason Smith will not say that's what he's doing. He doesn't want to set a precedent that we're always going to pay for extending tax policy. That's a big issue today. It's a huge issue next year when huge parts of TCJA come up for expiration. If the precedent is being set that, okay, now we're going to start paying for tax extenders, there's no way you could come up with $3+ trillion of spending cuts or tax increases to cover the cost of extending the TCJA provisions expiring next year. So a little bit of a semantic dance being played. I think the net effect is going to be, for those who are looking at the pure dollars and cents perspective, the ERTC changes will basically pay for the other pieces of the bill. But as a rhetorical perspective, Republicans will be careful in how they say that because they don't want to set a bad precedent ahead of 2025.
So some interesting provisions, but I guess they don't matter unless they are enacted. So Anna, do we have the skids greased for that?
No, not at all. While this step, this unveiling of this agreement is a really positive piece of the process, it's still unclear where many key players are on the proposal, including Senate Finance Republican ranking member Mike Crapo. He indicated today that this was a positive step, but he did not sign on to the proposal and indicated that, he may need changes. He didn't say that explicitly, but he's definitely not on board with the proposal just yet. Additionally, there are going to be Democrats in the House who also have concerns with the package as currently drafted. Ranking member Neal on the Ways and Means Committee has indicated that he would like to see a more generous child tax credit benefit. So it's unclear where House Democrats are on the package. And then it's unclear if Speaker Johnson's going to be able to use his time and his limited political capital to advance this package. Even if he does, there's another hurdle in the Senate where Senate Democratic leader Schumer is unlikely to devote floor time to this, as it will attract a lot of amendments, and those are hard to fend off. I mean, it's been more than a decade since you've seen a standalone tax bill move through the Senate floor under regular order, and that's simply because Senate leaders of both parties have said we don't have the time or the ability to manage our caucuses through that kind of process. So lastly, I think, Democrats really want to see this package enacted before the IRS filing season opens the end of this month. And that's because they want that child tax credit benefit to go out to taxpayers immediately. They want them to see the benefit this year. But, you look at the calendar and it's exceedingly difficult to see a path for that to happen, to see how this can get done before the end of the month. And so if it doesn't get done before the end of the month, is their enthusiasm then going to wane? So there's still a lot of questions, and we're still far from the finish line on this thing.
Got it. John, what's your take on the outlook?
Yeah, so there's two things that will happen this week that directly or indirectly bear on the outlook for this bill. I agree with everything Anna said, and I think we both agree it's an uphill fight, although this is a positive development for those hoping for a fix on the 174, 163J and bonus depreciation issues. Look, Congress has to act by the end of this week on a government funding package. We're operating under a temporary patch that for part of the government expires this Friday, for part of it expires February 2nd. We think Congress this week will pass a kick the can down the road that pushes the deadlines out to March 1st and March 8th, respectively. That's important because potentially that's where this bill could end up going on one of those funding packages being dealt with in early March. Secondly, we expect the Ways and Means Committee will consider this bill in a markup session where amendments can be offered by members on Friday. Jason Smith hopes, the Ways and Means Chairman hopes, to bring it to the floor. He would like to do it next week, but as Anna said, the House is on schedule to be at recess next week, which we think is not going to get canceled unless the government shutdown occurs because Congress can't pass the temporary spending patch, which means maybe the House would take it up on the floor in 2 weeks, but that would be again after the filing season is open, which creates lots of complexities for taxpayers and for the IRS. Jason Smith hopes that a big vote on the House floor to pass this would convince Senate Democratic leader Schumer to spend the time necessary to pass this bill as a standalone. He'd like to keep it separate from government funding, but as Anna noted, that seems to us exceedingly unlikely, given how difficult it is to fend off amendments from tax bills on the Senate floor. We expect the more likely outcome is if there's a big vote in favor of this in the House in 2 weeks, it leads House and Senate leaders to convince that this is sort of safe to airdrop into some other bill that's going to pass, like a government funding package. But look, this is a really important start, but it's really important to understand that there's not yet full buy-in from all of the members who need to be bought into this. And as I noted, the employee retention tax credit, for example, has some supporters on Capitol Hill. So there may be some pushback about using that as a, whether you call it pay for or just replacing bad policy with good policy. That may generate some pushback. As Anna noted, Senate Finance Committee ranking member Mike Crapo not fully on board yet for a variety of reasons. So a long way to go here, but clearly this is the biggest development on this issue in some time. It's rightly attracting a lot of attention. It's not appropriate to pop champagne for those of you supporting fixing some of those items, but it might be appropriate to put a bottle or two in the fridge just in case things break well in the next couple of weeks.
Well, thank you for that. And I look forward to talking to you both as this progresses, whether or not that's to take the champagne off ice or whether it is to pop the champagne, so to speak. Interesting times for us all. If our audience would like more information, you can subscribe to a weekly email version of Tax News and Views. All you need to do is go on Deloitte.com and search for that. You could also connect with John or Anna directly via LinkedIn. And of course, we hope you continue to tune in here for future tax policy editions. Thank you so much for tuning in today. I hope everyone continues to be well.